In this video, we're doing a basic introduction to accounting, and we'll be looking at our aim would be to understand why we create account. When we say accounting, what does that involve? Who are those interested in accounting information, as well as looking at financial and management accounting. Our focus actually will be on discussing a lot around financial and management accounting. So the first question is, what is accounting? If you do a bit of reflection, a number of keywords will come to mind. Accounting could be we keeping records, bookkeeping. It could be about assets, liabilities. It could be about investments. It could be about expenses. It could be a lot of those key terms would be what would come to mind when we think about accounting. But in the real sense, what is accounting? Accounting is usually defined, as you being able to identify economic events. So identifying transactions. Are you able to identify transactions? So accounting involves we identifying economic events, identifying, transactions, being able to record those transactions, those economic events, and being able to communicate those information that we have recorded to people who are interested in the information, so that they're able to make informed decisions. That then helps them to make informed decisions. So accounting is a process of we identifying economic events, recording those economic events, communicating the economic events to users so that they can, make informed decisions. That's simply accounting. We have, accounting is usually classified into two types: of financial accounting as well as the management accounting. And in financial accounting, what we do with financial accounting, which is a branch of, the general accounting that we have just discussed, is we being able to identify the economic events, so those transactions, record them, then communicate them, to communicate those financial transactions to users of accounting information. We usually would communicate those transactions, those economic events, using financial statements. So we'd report them, we'll communicate those events using financial statements to users so that they can then make informed decisions on those, on what we have communicated to them. What financial accounting does is that it looks at the past. So it looks like at the historic record of our company, of our business. So it goes backward. So we're at the year end. So maybe, our year end is December 2022. It looks at, January to December to say, what has been done, in this period. So it's looking backward. It's looking at past events. So those information then would then be recorded in the financial statements that we have. We have a number of them. We could record them in income statements, statement of financial position. We could record them in cash flow statement. All of these statements, we'll look at them, in subsequent videos. And the reason why these accounts are usually prepared actually is for external stakeholders. So external stakeholders for external purposes, so that users who are mostly outside of the organization, can have an in-depth overview of what is happening within the organization, and that would help them to make decisions. So it's for external purpose. We're preparing this financial statement, financial accounting for external users like shareholders, competitors can look at it, our suppliers can look at it, the bank can look at it, the government can look at it. All of those external stakeholders, can look at this accounting information, and they can use it to assess us, or to make some form of decisions and all of that. Also, financial accounting actually it's what is required by, it's a legal requirement of the business. So it is required of us legally to present the statements to the public, unlike what we'll see with management accounting. Also, because financial accounting looks backward, it looks at what has already happened. We can change what has already happened, right? So we hardly can use our financial accounting for planning or for control, for decision making, because it looks at the past. It's not something that we can change. It's done already. So those are the key, characteristics of financial accounting. It looks at the past. You can use it for planning, decision making, or control. We prepare this for external users, for external purposes. There's a legal requirement for us to actually prepare financial accounting. Provide those information to the public. Management accounting, on the other hand, are not for publication. So we're not required to provide it. There's no legal requirements, to provide management accounting information or to release it to the public. So we do not publish this accounting information. Unlike financial accounting that looks at the past, that presents information about what has already happened. Management accounting actually provides information about what is happening now, what is recent. We'll make estimates of estimates for the future. We're trying to strategize for the future using management accounting information. This would usually be, so management accounting actually is very useful for, to develop strategies for the business. So because we're not looking at the past, we're looking at what is happening, what could happen in the future. It helps us to be able to, develop strategies that will help make our business succeed. It's not legally required. It's not legally required. It's not for public consumption. It's usually, used by managers within the organization to be able to plan for the future or address issues that are happening now. Okay, so we know financial information actually provides information for people who are outside of the organization, for them to have an overview of what is happening within the business so that they can then make a decision. So say, for example, a bank wants to give us a loan. They want to see how far we have fared, in the past years or in this period of time, or maybe a supplier wants to, engage us in business. So they want to understand what trade terms you give to us. They look at our financial information, our financial statement, and they're able to make all of those decisions. You're an employee who wants to, work with an organization. You want to ensure that, the stability, you're going to be paid your salary and all of that. With the financial statement, you're able to gauge, how profitable the company is and if they will be able to, if there's a future in the company. And that's financial accounting. With management accounting, it helps the managers who are within the organization to see what is happening within the organization, how they're going to be able to then plan. These are the things we should do if we're going to remain in business. They'll be able to budget, they'll be able to say, well, these are the variants we're seeing. They'll be able to analyze their costs. They're going to do, a lot of things that then helps the business have a plan for the future or have a strategy that they have to, adopt. So the key difference that we have then between financial and management accounting are within either the users, the level of details, who, the range of information being protected and being provided, different key issues. So with users, for example, financial accounting, we've said is for external users who then will be able to make decisions using that information. Management accounting, on the other hand, is not for external users. It's for internal users, people who have control within the organization. Financial accounting is a general, the purpose, the nature of the report produced is actually a general overview, so it's general, it's for general purpose. Management accounting, on the other hand, it has specific purpose. So we're trying to look at our budgeting. We're trying to analyze our costs. We're trying to forecast for the future. We're trying to, there are specific purposes why, management accounting is being prepared. All the information is being made available. Financial accounting actually is it's just broad, usually broad overview. It's just an overview information. But with management accounting, because it helps, we use that for decision making, for control, and all of those is usually very detailed. There are, regulations around financial accounting, but management accounting is not regulated. It's not, you're not mandated to produce that. But with financial accounting, you're mandated to produce it. There are regulations that, surround how you should provide, what information you should provide, how you should be provided, what is material and immaterial, and all of those key issues. Financial accounting, usually, there will be reporting intervals, whether it should be, reported annually, biannually, quarterly, and all of that. But with management accounting, is as required by those who need to make decisions within the organization. So the managers is that required. It could be daily. If it is, if the information is required for immediate decision making, you need to know what to do and all of that. It could be monthly. It could be as required, by decision makers, the managers who will be making decisions within the organization. We've said financial information. Financial accounting looks at the past. Management accounting looks at the current and the future. A lot of the times, financial accounting is purely financial information, whereas management accounting is, both financial and non-financial information is what we are going to do. Okay, great. So far we've looked at, what accounting is. We've looked at the types of accounting, the difference between financial and management accounting. I want us to take a few minutes to then note, you can pause the video and then think, why do you think we create accounts? Why bother identifying economic events? Why bother recording them? Why bother communicating them? Why? Why do you think we go through all of these processes? And who do we think is interested in this, information that we're recording or communicating? So you can pause the video and think about it. Why do we create accounts? Who is interested in these accounts that have been created? Okay, so hopefully what came to mind for why we create accounts is that, you want to, as a business owner, you want to know, are you making profit or loss? And the way you can know if you're making profit is if you have kept record, right? You want to know, okay, if I'm making profit, what do I need to keep doing to make profit? If I'm making losses, what are the steps I need to make? Do I need to cut some of my expenses? Do I need to cut down some costs? Do I need to increase, my revenue? Do I need to do this? Do I need to do that? Also we create account because, you want to know how much tax to pay. So for the taxman, you want to also be able to know if it were to be a partnership, for example, what share of the profit should go to which partner, what share of the cost should go to which partner. If it was a company, how much, profit have we made, how much should be paid as dividends to the shareholders. You want to know all of those key things. It's a legal requirement as well, like we mentioned when we're differentiating, between financial and management accounting. Financial accounting, especially, there are legal requirements for you to provide this accounting information. Also, you want to be able to make future plans, be able to make decisions, right? You want to be able to control things within the organization. We create accounts because of that. You want to use it to attract shareholders. And what do we mean by that? When you want to invest in a business, you want to know that, the business is doing well. So as an existing company, you want to provide people, investors, potential investors, and even existing investors, that information that helps them then make an informed decision as to whether they should continue to be with your business, they should invest in the business, or they should, divest, or what should they do with regards to your business. Also, as a business, you want to know, are there areas where we're doing well that we should keep doing? Are there areas we're not doing well that, maybe we should not be involved in that part of the business anymore? So those are the reasons, amongst many other reasons, why we usually create accounts. Who are those interested in accounting information? So users of accounting information. So we had mentioned before now that accounting is that you're communicating this information to users so that they can make informed decisions. Users could be potential investors, people who haven't invested already, who are looking at, varying opportunities to invest, or existing shareholders who have already invested in the business, or you're looking at bankers, for the purpose of if you were to take a loan from the bank wants to know that you're creditworthy, you're able to repay, and all of those. Your suppliers as well, would be interested in your financial information, because if they're going to give you trade credit, or they are having, different plans, they'll be able to make those decisions as to, how to support the business, or how to ensure that their business with you doesn't get them into debt as well. The taxman is interested, employees are interested, your competitors are interested, and surprisingly, yes, your competitors are interested in your business, because again, they want to look at your accounting information to see, to compare that with themselves, to see where you're doing right, where they're doing wrong, what, checking on each other. Analysts are interested in your, in your accounting information. I hope that you have more, stakeholders, people who are interested, in accounting information that you have listed beyond this. All of these people that we're saying are interested in the accounts of, of a company and in the information being provided, we refer to them as stakeholders. So the question is, who are stakeholders? Stakeholders are those who are interested in your accounting, in your financial account. They're interested in the business. And the reason they are interested in the business is usually because they can influence the outcome of the business, or the outcome of the business can actually influence them. They can be affected with what happens within the business, or they can influence it. And that's why they're interested. So anyone who is interested in your business actually is your stakeholder, and I'm sure you can think of numerous of them. Stakeholders are divided into internal stakeholders and external stakeholders. So for those who are within the business, who are within the company, who are within the entity, who are interested in, what happens in the business, we call those internal stakeholders. Usually they are the employees and the managers. They are usually interested, in what is happening in the business. Those who are outside of the business and are interested in the business, actually, we call them external stakeholders because they are external, they are outside the business. So we can think of the shareholders, the competitors, the government, all of those, suppliers, the local community are all outside of the business, but they're interested in the, in the business. They're interested in the outcome of the business. They're interested in the activities of the business because whatever happens with the business can influence them. And they themselves, in different ways can influence what happens within the business. So far we've looked at, why we create accounts, who are those interested in the accounts, and and that has led us to discussing stakeholders. Okay, so we'll be ending with this part, looking at what are the rules guiding, we had mentioned that, especially for financial accounting, that, it is highly regulated. There are rules guiding the preparation of accounts and standards that needs to be followed, and which I just want to give an overview of those. So certain rules guide the preparation of financial accounts and the accounting information that we consider material that the public needs to know about, or that our shareholders need to know about, and all of those things. And then, of course, to be able to have comparisons, across companies, these standards are also being set. So we have the IASB, the International Accounting Standard Board, the company laws, the Financial Conduct Authority. A lot of standards have been created to ensure that, different companies, when we then bring out various financial statements, you can compare them. Nobody's just doing theirs, abstractly. There are guidance as to how accounting information should be presented and what accounting information also should be presented. Okay, so in this video, we'll be stopping with that. And in the next video, we'll be looking at different types of entities, and the objectives of these entities. I'll see you then.